Okay, I have started the recording and welcome everyone to another free webinar brought to you by optionslam.com. We're going to continue with we started a discussion last week that had to do with taking advantage of trying to exploit the implied volatility crush that is associated with an earnings event. And Stephen was so kind to provide to us a bunch of slides that he had created on some trades that he did with something that he dubbed the name Iron Eagle. And we got into that discussion pretty good last webinar. But I felt that there were a lot of loose ends that need to be cleaned up. So, and I want to expand the discussion. I want to expand the discussion because I think it needs to go beyond the at the money calendar that Stephen was working with. And so I want to introduce today double diagonal. Gives you a little bit wider window within which to win. It's the same concept though, looking for implied volatility crush as the avenue to provide profits. Well, let me get through the preliminaries here quickly and we'll get into it. Okay, so first of all, the CFTC rule. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. And our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment advice or investment recommendations. Instead, we are here for educational purposes only. These webinars are provided to you for educational purposes only. And let's see. And then I am Marco. And this is my email address, optionslam.com@gmail.com. Please send to me your questions, your comments, your suggestions. I'm open to suggestions for future topics that we can cover in these webinars. We cover everything options and earnings related. We like to use options to take advantage of the wide variety of ways you can control your risk through trading options, and we like to trade options around earnings events. We look at any and all strategies. If you have a strategy that you like, please bring it to the table. We would love to have you share with us some of your experiences in trading, like Leonard has done with us. Stephen has now done it. If you have some things that you'd like to share, shoot me an email, optionslam.com@gmail.com, and we'd love to hear from you. And Stephen, for example, wasn't able to actually present his strategy because he has a regular full-time job, as many of us do. And so he just provided some PowerPoint slides and asked me to cover for him. So that was fine. Leonard came right on Leonard was here twice, I believe, right, Leonard? I think you were here twice, a couple times you presented about Ichimoku. So yeah, we'll even be glad to talk about your favorite technical indicator that guides you and steers you to your options trades at and around earnings events. Okay, with all of that said, this is slides left over from the last webinar. that that was an introduction into this concept about exploiting the implied volatility crutch. I'm not going to go through the slide in the interest of time, but we are. I just wanted to present the slide, and we'll just move right on along here because I think there's quite a bit to cover here today, and so let's see. And then, of course, these webinars are recorded, and that way, this gives you an opportunity to take a screenshot, or you can come back and look at the recording to see what the text is here in this particular slide. So strategies that benefit from implied volatility crush, some of them are unlimited risk, okay, or undefined risk. Undefined risk, unlimited risk, kind of the same thing. So most short option positions, when you're selling options, they're going to benefit from IV crush. Now, are they all going to be winners? No, because they're directional. Some of them are directional, I should say. So if you sell a call, that would be a bearish strategy. If you're right about direction, that's great. You're going to that's going to be a winning trade. But there's an additional benefit, and that is the implied volatility crush. So that's why. So these are undefined risk strategies here on this page. But if we move to the next screen, the next slide here, these are defined risk strategies that we talk about. That so the maximum you can lose, in other words. And a defined risk strategy, it is your risk is limited to X amount of dollars. Going in, what's the worst case scenario? If this turns out to be a losing trade, what's the absolute worst I can lose? So that would be a defined risk strategy. So these are the most common ones that we often talk about. But last but not least are calendars, which we covered fairly extensively in the last webinar, but we didn't touch on diagonals. And I'm going to jump right into double diagonals today as a exploitation of the implied volatility crush. Okay, so let's see. I think this is left over again from last webinar. This was one of Stephen's slides. Stephen provided, I skipped all of his specific slides. If you want to see the last webinar, if you weren't here to see the last webinar, you can go to optionslam.com to the resources page here, to the resources tab, and then the first top one there, the top link available is the Option Slam webinars. Click that link and it will take you to all of the historical Option Slam webinars, and there are years and years worth of webinars stored there. Okay, lots and lots of webinars for you to take in. Okay, all right, and let's see. Ideal Iron Eagle candidates, and then he went on to even actually give us, Stephen did this for us last time, he went on to give us a bunch of stocks that were coming up. The last webinar was October 18th, and at the end of that day, Netflix was reporting, United Airlines, Abbott Labs, etc., and he gave us a bunch of stocks that were reporting. Now, I did run this morning, I ran a few back tests on a few of these stocks. I want to share those with you. I ran the back test through optionslam.com's back testing tool. So if you're an insider member, to optionslam.com, you not only have access to the historical archived webinars found under the resources tab, but if you're an insider member to optionslam.com, now if you're not an insider member, there's a lot of free information. There's a lot of great information available to you, but not everything is available unless you're an insider. If you're an insider, then you get access to the archived webinars, and you get access to our OSBTT, the OptionSlam backtesting tool. If I click on that and open it into a new tab, I can go in. This is the opening screen of the OSBTT, and this is what I used to backtest some of the stocks that Stephen had brought to the table that were upcoming opportunities. And I'm going to show you a few backtests. But first, let me read to you something that Stephen wrote to me. He wasn't able to attend the last webinar, but he took it in. He took in the recording on the weekend, and he followed up with an email to me. And I'm going to read an excerpt from that email from Stephen. So again, many thanks to Stephen for sharing the trades and the concept that he dubbed with the name Iron Eagle, and an excerpt from his email to me after he was able to take in the recording. He says, one of the challenges I've always had with any backtesting software is that most use end-of-day pricing. And what I've found with these trades, the Iron Eagles, is that while opening or end-of-day gaps may be wide, there are often intraday moves that bring the stock closer to the previous day's closing price or into the profit zone that aren't reflected in the market open or possibly in the end-of-day pricing of the options. I'm not sure that there is an easy way to model this without looking at the entire trading range of the underlying on the day following the earnings announcement. So remember, Stephen's strategy was to put the trade on the day at the last moments before an earnings announcement, and then take that trade off very early in the day at the first opportunity or at an early opportunity immediately after the earnings event came out. So he was really, truly exploiting the IV crush. So he goes on to say the data in the weekly moves chart and data grid is good, but the data grid only highlights the maximum and end of day moves. And then he goes on to ask me if OSBTT or any of our information can dial in on intraday moves. And the answer is no. We purchase our end of day data that supplies the OSBTT and supplies the rest of the website with all of the other statistics that we provide. For example, if we go to a specific stock, like Netflix is one of the ones that I did back test. I think I did Netflix. I know I did Tesla. I did a few others. But if we go to a specific stock at OptionSlam, all of this data comes from we purchased data from a vendor in order to build and provide data over to you folks. Okay, so and what we purchase is end of day data. We don't purchase intraday data. The end of day data alone is already very expensive. So okay, so we don't purchase the intraday data, but there are some backtesting tools that do use intraday, that do have intraday data available. There's OptionView is one of the software, one of the programs out there. OptionView is a website. There's OptionNet Explorer. That's another one that has intraday data that, and they have back testing capabilities. So there are others that are more capable. Our data and our back testing tool is restricted to end of day data only, so that is a limitation. However, one thing really nice about OSBTT is that you can capture all of the results and download the results into an Excel file or whatever program you use for your spreadsheet, and save that data, save that information, and create a backlog, a history of back tests of your strategy to prove to yourself that your strategy, has merit. Okay. All right. So now moving on. Where did I leave off? Okay. So I'm going to go ahead and show you just a couple of back tests here. And there's a lot of detail and there's some inner workings here that, so one of the trades, so we'll start off with a trade that I modeled up in the last webinar, and it was ABT. Well, that trade turns out to not have been a winner, but let's take a look at that trade. And here's the results that are downloaded right out of the OSBTT. So I put the trade in OSBTT, and then I asked OSBTT to download the results to Excel. And so here is two trades. You see there's two tabs here. Let me, can you guys see this okay? Is that big enough on your screen? I hope so, because I don't really want to take time to. Yeah, Daniel asks, is your term Iron Eagle synonymous with Iron Condor? No, not at all. Not at all. It's a completely different concept. So that's that was Stephen gave that. So we have a trade that we teach about that I have named, something that I've named the Double Eagle, and so the Iron Eagle is kind of taking off of that concept, that theme. That's where that name comes from. So it's something really specific. It's not out there like the Iron Condor is. The whole options world knows what an Iron Condor is. Not a lot of people know what a Double Eagle is or an Iron Eagle. Those are kind of things that we've kind of created here in-house. Okay, Daniel? So stick around and you will. There's a lot to learn. Two option other services, intraday data. The other two services that I mentioned were option view. Okay, these are pay programs. Option view, VUE, they spell it, and option net explorer. They both cost about $88 a month. The last I checked, they're fairly expensive. And they're back testing tools. They're not brokerage houses that you can't actually trade there. Well, you can, but you have to have. They're not brokerage. They don't have brokerages built into them, but they do affiliate with a couple brokerages. Okay, so hopefully that answers those questions. Intraday backtesting service that you mentioned, other than option view. Okay, option net explorer, also known as ONE. ONE for short, Option Net Explorer. All right, so back to OSBTT. So here's the results out of OSBTT. This is what we call the metadata. This is kind of the information that we feed into the OSBTT. And then here are the results of the trade. So so you can see here what we did, and I did both a put calendar and a call calendar to illustrate something that we talked about in the last webinar. And that is that calls are puts and puts are calls. It doesn't matter if you do a call calendar or a put calendar. They're both essentially about the same thing. Many traders will look at an at-the-money calendar spread and say, well, I'm going to do the put calendar, and then that trader's buddy says, well, I'm going to do the call calendar because it's cheaper. And then on another stock, the put calendar might be cheaper. And it's really usually a function of which one is in the money and which one is slightly out of the money. They're both very close to being at the money, but neither one. For example, here you see the price of the stock was 104.98. Well, it's 2 cents. When you're looking at the puts, it's the 105 is 2 cents out of the money, whereas the call is 2 cents in the money. Okay, well, that's very close to being pretty much the same thing. So I wanted to illustrate that it doesn't matter whether you do the put or the call, even if it's 2 cents or $2. If the in the money, out of the money, it doesn't matter. They're both going to act the same way. They're both going to give you very, very similar results, unless, I'm going to just throw this in, I mentioned it in the last webinar, unless your stock has dividends, and your stock has a dividend that's going to become payable during the cycle in which your expirations in your calendar are affected, okay? So in that case, if your stock has dividends, then you can't just go with whichever is cheapest, which is cheapest, the put or the call. Then you need to start looking into something we call the jelly roll. I'm not going to get into the jelly roll, but it's a mathematical formula that takes into consideration, just like a Black-Scholes formula, it takes into consideration the impact of dividends on the options pricing model. Okay, so but we won't get into those details. So now the puts are calls, calls are puts is true in a calendar spread up to and including FE day. I'm highlighting FE day. What is FE day? That's the front expiration day. You see that in this case, we are short the 105 put. You see my cursor there? We are short the 105 put that expires on 10/21. That is the front options expiration day, okay? And I've just highlighted that here by typing that in manually, that this is FE day. Now on FE day, things change depending on whether your fronts are in the money or out of the money. If they're in the money, then you need to cover your shorts in order to continue on the trading. And OSBTT does all of this math in the background, okay? The OSBTT has been developed to do all of this math in the background. I'm just going to show you some of what that math is so that you don't have to scratch your head and try to understand it and try to figure out what's going on in the background. So that's why I've added a little bit more information here, what happens with the put. So yes, call calendars are the same as put calendars up to and including FE day, but after FE day, they're not the same anymore, because at least in the back tester, because the back tester takes into consideration any short cover that you may. If you covered shorts, then now you have more risk on. You see the risk here. The original debit was 187.50 to get into this trade. So I've just copied that over here. That's the original debit to get into the trade. But if you do the put calendar, then you're going to have to come on front expiration day, 10/21. You sold the 105 put, and now the stock is trading at $95. So these options are $10 in the money, $10 in the money, specifically exactly $9.94 in the money. If you want to continue trading and keep your longs and not get exercised against, right? If you don't want that stock put to you because you were short a put, you would need to cover your shorts, okay? And that would cost you $994, bringing your total risk in this trade up to 1181. But now all of that is taken into consideration. You don't have to just know and trust that OSBTT has done all the math for you, but it assumes that you are staying in the trade in order to continue giving you results for the following days past FE day. That's what's happening here in the background. I hope this is making sense. If you have questions, go ahead and type them in the chat box there. So let me just, so what the value of your long, so now the fronts are expired, you paid $994, the intrinsic value, to close those fronts so that you can continue holding your long put, okay? But the reason you're still losing money here is because you've got all this extra risk on board, okay? And then if the stock continues to go down, 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 this trade could turn actually profitable, okay? Because you only own the long put now, okay? Even though you've got $1,181 invested, you only own the long put, and that put could become valuable if the stock falls far enough. Now, I hope I've explained that. I hope I haven't confused you. It can be confusing, but you can go into, well, let me continue on because there's just too much to cover here, and and time goes by way too fast. But let's look at the again, the main point I want to make here, and I'm going to leave all that other information aside. The main point I want to make is that the puts and call calendars act almost exactly the same through FE day. After FE day, the fronts expire, and whether you covered them or allowed them to be exercised against you, in either case, the ramifications are different for an in-the-money calendar spread than they are for where the fronts expire worthless. So let's look at the call, because in the call on FE day, if you use the call calendar, you can see that I made some notes on FE day. The short call here expires worthless. So you are left with your long call, and there is no front cover, and there is no worry about exercise and assignment. Your front expires worthless, and you are just left with the trade. But the results, so let's take a look. You see the results here for the first 3 days of the trade: 122 loss, 167 loss, 171 in the put. Go over to the call, 121, $1 difference. Okay, 174, 182, only a dollar or so difference in P&L difference, profit and loss difference between the call and the put through FE day. But then after that, things change because of the short cover. Okay, enough on that. Anyway, bottom line is the ABT trade that we modeled up did turn out to be a losing trade. That did not work out well. Okay, so what else? I'll just show you quickly. Let's see. I've got several I did here, but I'm going to zoom through these. Here's Netflix. This one used. I just did the call. I didn't do the put, but the call would have required a short cover. Okay. Or if you don't cover your short, then you are going to get exercised against. They're gonna put that stock to you, and you're going to be excuse me. In this example, you're going to be called. So they're going to call that stock away from you, and you will be short the stock. Okay, so if you hopefully that's clear. So anyway, Netflix turned out to be a losing trade in the first days, and the way Stephen models this trade, he's out of this trade the first day. He's out of this trade sometime in that very first day. It either works or it doesn't work. Correct me if I'm wrong, Stephen, but I don't think Stephen sticks around crossing his fingers, hoping that things are going to turn around. But OSBTT is a back testing tool, and we can carry the trade on. And again, OSBTT does this for you. It covers the short in the background. It does all this math. So it's already figured in starting on the 10/24, which is the Monday after front expiration day. This back cover is priced into this P&L. Okay. And you can see if you would have stuck around and taken on all this extra $5,000 more worth of risk, this did offer an opportunity for profit. It did offer an opportunity for profit, but it would have required a little bit of sweat on the part of the trader. What else do I have for you? I'm going to show you quickly two more. UAL. Oh boy, we're already. UAL. I did a put. The put calendar. The puts expired. Oh, the front shorts expired worthless. But had you done the call calendar, you would have had you can see that the strike was 37. Front expiration day, the stock was at 40.44. So there's $3.44 of intrinsic value, requiring a $344 short cover. Okay. And then last but not least, I'm going to show you Tesla, because with Tesla, I did something different. I did a Tesla calendar spread. Okay. What we've dubbed as the Iron Eagle. This is the at the money calendar spread. And this actually didn't pan out on the first day. Okay, didn't pan out on the first day. Held to FE day, there was a $150 profit against a $900 at risk. This is a defined risk trade. And let's see, this is using calls, and you can see that on FE day, the price of the stock was lower than the 223. This is an oddball strike because Tesla had recently split, and when a stock splits, then there's the creation of some oddball strikes, oddball numbers. You know, it's not the standard 220, 225, 250. There's some oddball strikes because of what the price was on split day. But anyway, so these fronts expired worthless. Okay, so that makes it simple using the calls here. But then what I did is I wanted to compare this trade to the double diagonal. Okay, I told you that we were going to talk a little bit about the double diagonal today. So the at the money calendar gives you a window, a profit window in an Analyze tab. If you use the Analyze tab, I use Thinkorswim, and I don't know, some of you use other programs, but we illustrate a lot of our trades with the Analyze tab. So I don't think, now these options have expired, and I didn't take screenshots, so we'll have to go to something live here to illustrate this in Thinkorswim today. But let's look at the double diagonal. The double diagonal uses 4 strikes. The double diagonal is slightly different than a calendar, and the idea of the double diagonal is to create a wider profit window than the simple at the money calendar. So one of the complaints that some traders have about the iron calendar, the iron eagle, is that the profit window is too narrow. Well, that there's some truth to that. It's narrow for sure, and I'm going to illustrate that here. And so widening the strikes out to create a wider a profit window is the objective here to doing the double diagonal. Double calendars can be used as well, but I found with this this desire to exploit IV crush, the double diagonal sometimes has some advantages. Okay, but there's a lot to talk about here. There's a lot to, as they say, unpack here. So let's go over to optionslam.com and let's go into the stock screener. Okay, we'll go to stock screener, which is pretty much the most popular page at optionslam.com. This is where most insider traders go to see what's coming up in earnings. So I saved a few different ones here, saved a few different sets of screening. I just generally use my generic screener here. Let's look at that. And it says that my generic screener just is really very generic. It says stocks that have weekly options, stocks that have an EVR over 1, stocks that are priced over 20 bucks. I can change all of these parameters on the fly, but this is just my saved generic scanner. And based on those criteria, I've got stocks that have got earnings coming up in the very near future. Now, some of these already reported this morning before the open. Okay, so here you see November 1st, BO. BO is before the open. But here, what do we have? November 1st after the close. Starting here, AIG is going to be reporting today after the close. AMD, here's one that's going to be reporting today after the close. Well, let's just right click on that and let's go over to AMD. That's a pretty liquid stock. Let's right click on that and open that in a new tab. Let's go take a look at AMD at optionslam.com. Now, if we were going to be looking at doing this, applying a strategy such as take advantage of the earnings volatility crush, implied volatility crush that happens at earnings, we would be looking to put this trade on today before the close because they're going to report after the close today. So, so let's go over to Thinkorswim and let's look at AMD and let's look at the all right, there's AMD, and we'll go to the live options chain. And if we were going to do this trade, where's my weeklies here? Let's see. I'm only seeing. I went to my simulated trading, and I'm not used to using this one. I usually use. Oh, I won't bore you with the deal. How do I get all options here to list in this? Let's see, options chain, filter off. Somebody help me here. How do I get it to show the weeklies also here? Because I'm sure AMD. Oh, I see. I'm not on AMD. I see the problem. AMD. Okay, there we go. It didn't pick up that I will switch to a different stock. Okay, there's my weeklies. They're there now. They are there now. Okay, sorry about that. All right, so the stock is trading at 60 bucks. If we went with the Iron Eagle, we would go to either the $60 put or the $60 call, and we would buy an option. Some folks Some folks gravitate to the calls just because they tend to be a little bit more liquid most of the time, because usually there's more. Oh, yeah, I don't have my, let's see, my layout. Delta, Gamma, Theta, Vega. Let's do that. Oh, shoot. All right. And then, well, that's looks a little bit more like what I'm used to. I don't use this. All right. Anyway, let's see. If we would just do the $60 calendar, let's look at what I'm talking about. Let's buy the calendar. Now, I'm going to go ahead and accept selling November 4th, but I'm going to move this out to the November 18th regular monthlies to give my backs a little more time and less theta decay, less time decay in my back. So I'm moving those out further in time. Still a calendar spread. It's just not using adjacent weeks of the 4th and the 11th. I'm going out an extra week to the regular monthlies, and I like using regular monthlies because they tend to be somewhat more liquid. Now let's look at what that looks like in risk profile. Okay, so there's our profit window. The options expire, the fronts expire here on November 4th. So let's see what one standard deviation. Now this looks good at first glance, but where we left off in the last webinar was talking about modeling IV crush. What this illustration doesn't tell you is that the implied volatility is going to crush tomorrow morning at the open. This implied volatility is not going to be there anymore. Okay, I'm getting into some advanced concepts, so stick with me here. Look at how this implied volatility is screaming high, 118 points. Now, to model this, and we did some of this work in the last webinar, to model this, we need to go back to and find out what is the IV crush that we might experience. So what we can do is we can go back to August 2nd, and we can go back in think back mode. Okay, this is Thinkorswim's back tester. It also uses end of day data only, just like OSBTT, but it doesn't have the advantage of being able to download the results. So that's why I prefer the OSBTT, because I can download the results to my Excel spreadsheet. But what ThinkBack does do that OSBTT doesn't is it gives us some implied volatility data. Okay, some implied volatility data. So let's go back and let's find out what was the IV crush back on the last earnings event of August 2nd. Okay, let's go to AMD, think back, and let's go back in time to August 2nd, which is they're reporting after the bell on that day. You can see the IV was screaming 121 of IV on that day for the fronts, and the backs, had we done a similar trade back then, the August 19th regular monthlies would be the same as what we just modeled up in the live options chain that I just showed you that modeling. We used the November regular monthlies. So let's take a note. We did this last time, and we're going to do it again here. I'm going to just jot this down on a piece of paper. So the IV was 121 in the fronts before the earnings event, before the earnings news came out, and the IV was 68 in the backs, 68 in the back, what we call the back expiration. So we're shorting the fronts, buying the backs, okay? Now I'm not going to put this in as a back test or anything else. I'm going to just simply look at the IV And we're going to go forward a day and see what the IV is after the news comes out, okay? So go forward one day. The fronts crush all the way down to 64, okay? So 121 to down to 64. And I'm really good at math, but when I'm talking, I can't do math in my head very well. So I have to rely on a desktop calculator. That's a 57-point drop, okay? The drop was 57 points in one day. That's what we call IV crush. Implied volatility went from 121 down to 64. It dropped 57 points in one day. But our backs also dropped. So our backs were at 68. They dropped down to 50. That math I can do. That's an 18-point drop. Okay? So that's what happened last quarter. That's what happened last quarter in a one-day move on the AMD stock. So now what we can do is we can go back to our live trade and look at our risk profile, which this looks pretty good. It looks like we're wider than one standard deviation with a profit tent, right? But if I model in the implied volatility crush, it will change the picture. And this is where what we didn't get into is I wanted to show, this is where I wasn't able to we ran out of time last webinar. So this is where you can model in with Thinkorswim. We can go here to this gear. You see where my cursor is over here to the right side? And we can open up some parameters to model in a volatility adjustment. And we can click that again and click on more parameters. And now we can model in an IV crush of our fronts and our backs. Now, will the IV crush this quarter the same as it did last quarter? No, not exactly. But will it be similar? We assume it will be similar. All other conditions are right. The separation of weeks, the how far it is, how many days it is to front expiration, how many days it is to back expiration. All those conditions are very similar in this hypothetical trade that we have on the screen as compared to the last quarter trade that we just looked at in ThinkBack. So let's use the drop of 57. So I'm going to take the fronts, those options that expire here in just a couple of days. I'm going to take those and I'm going to drop those by why did that go down? All right, let's I want a negative number there, and it's going to be negative 57 points. But I also need a negative number here. My longs are also going to lose IV. So I want to make this a negative number. So I'm using the minus button here. Let's see, can I see that? Is there a way? It's hard to see that for some reason. It's not showing up very good. There, it looks a little bit better. All right, and now I'm going to take those options and I'm going to subtract some IV there. And that was last quarter, that was down 18 points. Okay? Down 18 points. Now, when I do that, I have IV crush in my fronts, but I also have some IV crush in my backs. Okay? And so I'm taking into consideration all the IV crush, not just the IV crush that helps me, which is that in the backs, but I need to also take into consideration the IV that kind of works against me to see what the whole total real picture is. And you notice here that the risk graph now has come in substantially, and this is what I was talking about. So I have a limited window of profit now that is not wider than one standard deviation wide anymore. As the modeling software predicted, without modeling in those IV crushes, the modeling software gave me a false impression of where the profit window was. This is a more, in my opinion, this is a much more accurate impression of where the profit window is. And it's still pretty good. It consumes pretty much almost all of the one standard deviation as extended out until the front expiration day. One thing I didn't do though is I didn't go forward a day. I need to go forward a day. So that this one more thing is this IV crush doesn't happen until tomorrow. So by tomorrow, I need to go forward a day and to take in the rest of the picture, and that has to do with theta decay. So that kind of brought in the lines of the one standard deviation move. And as we get closer and closer to front expiration day, of course, those lines come in tighter and tighter and tighter. So there is the AMD. Looks like if IV crushes similar as it did to last quarter, it looks like there's profit available in this trade if the stock stays above $56.91 or below $63.54. I'm just reading down here. I'm putting my cursor at the break-even point and reading the down here what price my cursor is at, and it's at $63.51 right there, and it's at $57 basically on the downside. So if stock stays within basically a 3-point range up or down, it looks like this could be a profitable trade. Now let's compare it to what the other alternative is, and that is the double diagonal. And I'm going to leave the modeling of the IV crush in there. Let's see. I don't see any questions, so I'm going to assume that means that you guys are following along and that this is making sense, because I'm not seeing any questions. Let me look and make sure I didn't miss any. Yeah, no, I'm not seeing any questions. So good deal. I'm either you guys gave up and you left the webinar, or you're still here and you're still following, and this is making sense. I hope the latter is true, more true than the former. All right, so let's look at the opportunity now to do this with and theoretically widen. Okay, so with options, there's always a give and a take. If I'm gonna get something better, I'm gonna give something away to get it. If I'm gonna get a wider window of profit, I'm gonna have to give something up for that wider window. It might be more risk, it might be less profit, it might be both, it might be, this or that or something else, right? But let's just take a look, and let's take this trade off of the screen by just unchecking it. Let's go back to add simulated trades, and let's look at a double diagonal. So modeling up a double diagonal, I'm going to go. I'm not going to go out a whole implied move away, which is about. Let's see. You can calculate it by looking at the money straddle, but let's just do a modest. Let's see. Do I have? Let's make sure we have the options available. Yes, excellent. We have the $1 increment options available in the November 18th. So that's awesome. So we can do what I was working up towards. So let's go to the November 4th. Let's first. Let's do a double diagonal. Let's just go out. Let's go out $2. Let's go to the 62. let's sell the 62. I'm going to model up a different trade here now. Okay, so watching down below, you'll see me model this trade up. I'm going to sell the 62. I'm going to also sell the 58. So right now I've sold, I used my control key. I held down the control key in order to create this into one trade. And now I'm going to go out to the November 18th, and I'm going to do this in the form of a diagonal. I'm going to go out a little wider on the diagonal. I sold the 62, so I'm going to go ahead and I'm going to buy the 63 call, and I sold the 58 in the front. I'm going to go out a little further out of the money. I'm going to buy the 57. So here's what I've done. I've created a double diagonal. I'm buying further out of the money contracts, and I'm selling closer in the money contracts only by $1. And let's take a look at, and I haven't changed my modeling. Remember, I've got my modeling is still showing the IV crush, because that's going to happen no matter what trade I put on, right? So let's look at the risk profile now, and you can see what happens here is I actually do get wider break evens with this trade than I do with the calendar. Okay? I'm forward a day into November 2nd. I'm using today's pricing for the options. The debit for these two trades is very similar, only $20 difference in the debit, but this one's a little more expensive. Yes, I could design it so it's actually cheaper. I could do that, but just by widening my longs further out. But when I do that, I take on more risk. One thing I need to explain here is the risk is defined, but it is not just the debit. It is the debit plus the spread. And the spread, if you'll remember, I went 57 versus 58 in the puts, $1 wide spread. So this double diagonal actually takes on the risk of the debit and the spread, the $1 spread. So it actually takes on a total risk of $238 as the worst case scenario. Whereas the calendar only takes on the actual debit itself. That's it. There is no other hidden risk in spread risk or anything like that. So remember I said that when you want, the goal was to widen the profit window, because remember with the calendar, the profit window is here, okay? Only at one standard deviation. With the double diagonal, it's wider than one standard deviation. See that? And I could make it even wider just by tweaking the strikes that I use. I could make it even wider. But things happen. I take on more risk, and I lower my maximum profit. You see here, the maximum profit is $108. Let's go look at the calendar. The maximum profit on the calendar is $131, okay? But the calendar has to hit $60 in order to get that profit. The diagonal has that profit across a very wide range, almost the entire one standard deviation. So do you see why there's some advantages and why some people are going to be drawn to this double diagonal trade in looking for the opportunity to exploit implied volatility crush through an earnings event? All right. So the trades are very different in some ways, very similar in others, advantages and disadvantages, and it's all the magic of options trading. All right, well, I'm going to take a quick look here. We're out of time already. I'm going to take a quick look here. It looks like there might be some questions here now typed in. Let's see. Yeah, let's see. Hard to read. This is very small. Let me see here. Um, what is the composition of your Iron Eagle and Double Eagle? Well, yeah, not enough time. Double Eagle is a completely different trade. Completely different trade. It is not a through the earnings trade. I'll be talking about the Double Eagle in a month or so. We're going to have another workshop on that. The Double Eagle is actually my. Oh, if you're an insider member, you can learn about the Double Eagle by going to May of 2021. I did a webinar about the Double Eagle, and then I actually hold classes on the Double Eagle. It is my own personal favorite trading strategy. I trade the Double Eagle religiously, pretty much 365 days a year. I am in Double Eagle trades. But no time to get into that today. For my own personal analysis, I'm reading a question here. I am looking for options, data, price, Greeks, volatility for various strikes and various expirations captured at various points in the day. One place I look, yeah, I don't know what that website is, so I can't mention it. I don't want to promote any websites that I'm, but thanks, Daniel, for that. Yes, a double diagonal looks similar in a risk graph to a double calendar. They are very similar. The big difference that I want to drive home is the double calendar is more expensive than a double diagonal, a standard regular double diagonal. That is, there is such thing as a double diagonal that is actually more expensive than a calendar. It's what we call a guts diagonal, but I'm not going to get into that. We're out of time. Maybe in the next webinar we can get into that. But the regular double diagonal is so let me illustrate. What if I would have done this as a double calendar? Okay, excellent question, Daniel. Let me bring that or comment, however you want to consider your typing there. Let's go back to add simulated trades. And let's just do a double calendar at the 63 strike. Okay, so where was our shorts? Our shorts were at 62 and 58. Let's use those same shorts. So let's buy this calendar, the call calendar, and let's also at the same time buy and hold my control key down so this all goes in, becomes one trade. Okay, so let's see. 62.58. That didn't populate how I expected it to. That's throwing me off there. I thought this would come up as a 62.58, 62.58. I need to go out to the long strike in order to do that comparison. I think no, that won't work either. I'm not sure. I must have done something wrong there. But let's see, the double diagonal, that looks right. And then a double calendar to compare. Oh, I know why. I had the wrong expirations. I got it. I know why now. Okay, let's do it. I know what I did wrong. Okay, here we go. All right, so let's do it again. We'll do the 62.58. We'll use the same strikes as the fronts. Okay. I know what I did wrong. Okay, buy that calendar and control buy this calendar, but I have to change the backs. I have to change the fronts and the backs. I'm in the wrong expiration here. I need to get to the same expirations here. So my shorts are going to be November 4th. And my longs are going to be November 18th. There we go. Now we have a comparison of using the same strikes in a double calendar is more expensive than a double diagonal. And I've adjusted so that we have all the same expiration dates. Okay, so the double calendar is more expensive than a double diagonal, but it's not as much risk. The double calendar has only $2.13 of total risk. The double diagonal has $2.35 of total risk because there is the spread risk added in. It's kind of a hidden risk that isn't as obvious. But what do the risk graphs look like to Daniel's comment? Here is the double diagonal. Take that off. There is the double calendar. They look so much alike, right? Okay. All right. Well, that's it for today. We're 10 minutes over time already. Thanks everybody for being here. If I didn't get to your question, please email me, optionslam.com@gmail.com, and I will try to address your questions, your comments by email. Thanks for being here. Hope to see you again in the next webinar. And goodbye for now, and good trading.